Suddenly, aliens come from space and they give everybody a MacBook Pro. What is up, people? The Force, another bank has crashed. First Republic Bank, as a matter of fact. So in this video, I want to talk about that. We're gonna go outside though, get a little bit of sun, and see if we can make a little bit of money off of the next bank run. But for those of you who don't know me, my name is Forrest. I invest in stuff I think that everybody should do. I also trade, do stuff like that. But let's go ahead and get outside and get into it. All right, guys, the banks, failures, the economy, trading, all very, very important. If you're in this video here now, you're probably somebody who is interested in trying to figure out a way to make money from this all. You might be a little bit concerned as well about the banks failing. Obviously, banks failing is something to be concerned about. You know, it's where we store our money. The banks control our mortgages and all of that. So first, let's talk about why bank runs happen. I did another video on this, which is out there, but I'll just remind everyone, right? So a bank run, one of the reasons that a bank can fail, it's not the only reason. But a bank run is just basically where everybody goes and withdraws all of their money at the same time. This is important because banks need a certain amount of deposits, right? They need cash on hand as collateral for all of the money that they're lending, as well as operational costs, things like that, right? They're charging fees on these deposits. If they don't have any deposits, then they can't charge any fees, right? So having money in the bank, at least some amount of money, is how they generate revenue ultimately. Now, here is the kicker. Whenever a bank run happens, right, that puts pressure on the bank. Everybody knows that it's starting to happen, so more people start to withdraw money. That also puts downward pressure on their stock price, right? So when a bank is under stress, if it's a publicly traded bank, which I think most of the banks that we're concerned with are, actually, I haven't really thought about that. A little side note for later, but that puts downward pressure on the stock. So what do you think happens when there's downward pressure on the stock? Well, everybody can see that, makes everybody worried, so people start withdrawing their money, and it becomes this big spiral downward. So banks are unique in that, you know, the way that they handle deposits can drive them out of business, but they aren't unique in that a sudden reduction in the value of their collateral can blow them up as a business. This can happen really in any business, right? If you're a business whose operational cost is ran via loans or something like that, and you have a sudden reduction in the value of your collateral, whatever your loans are backed by, you essentially can have a capital call, right? A capital call is, imagine I borrow, let's use an example, right? I have this laptop and I want to get a loan. So I go to somebody and say, all right, well, I'll give you a loan based off of the value of this laptop. Laptop's worth $2,000. They want a little wiggle room, so I borrow $1,500, you know, based off the value of my assets, which in this case is this laptop. Now, suddenly aliens come from space and they give everybody a MacBook Pro. Everybody on Earth gets a MacBook Pro. This MacBook Pro is no longer worth $2,000. It's now kind of worthless. So they're gonna come back to me and be like, look, man, I know we had this prior agreement based off the value of this MacBook Pro, but this MacBook Pro isn't worth anything anymore. So we're gonna need some different collateral. So I can go back to my pile of other stuff and I can sell some things to come up with a cash value equivalent, $1,500. I could pay off the loan, but ultimately I now have this downward pressure, but I have to go and sell something else. Now, if the other things that I have to sell are other MacBook Pros, now I'm in a real problem. This is what happens with stock, you know, right? If I'm a bank and there's a bank run happening, putting downward pressure on my stock, people are coming and saying, hey, you know, these loans, you know, you're upside down on these loans now due to the downward pressure on your stock, and now you're selling stock to try to pay up the loans from the downward pressure on your stock. So you have more downward pressure on your stock, and it just blows up. This can happen in any business, right? Not just banks, just that banks are unique in that part of their business is deposit. So there's all that. Let's take a quick pause so I can check my phone. So what can we do as investors in this situation? You know, I haven't talked about equity analysis in this channel in a while. I used to trade only equities. I've been trading futures recently, but like all things in life, it's circular. It'll come full circle. That's a little nugget for those of you who know me in my dancing life, part of a dance group called Full Circle, neither here nor there. But things really do come full circle, guys. Then we're back to talking about stocks, specifically bank stocks. So how do we figure out which deposits are under stress? Well, I think regional banks in general are under stress. I've talked about it on Discord quite a bit, right? The idea that, you know, one bank failing is just the tip of the iceberg. We've had another bank fail, and I think more are going to fail, guys. If you listen to what the Fed and people like that are trying to do, right? Jay Powell, they're trying to stop inflation. They're trying to stop printing money. Well, the only way that we can bail out banks is by printing money. And so every time a bank fails and we decide to bail them out, either JPM, quote unquote, buying them using a leverage buyout, but they're borrowing money from the government to do it, right? But printing more money, we're just exacerbating the problem that is inflation. So things are getting worse. They're not getting better. And so immediately my checklist, if I'm trying to make a list of banks that I think are going to fail, and maybe I want to buy puts on a bunch of different equities to the downside, I'm looking at all regional banks. First, I'm going to look at banks with the exact same or close to market capitalization as First Republic. I don't know what those are off the top of my head, but that's what I would do. So write this down. Look at banks with similar market capitalization. Look at banks that have similar revenue streams, right? So some banks are more into doing auto lending, some are doing mortgages, some could do regional mortgages, some banks might have overseas businesses, right? There's all these different types of debt products and things that financial institutions could get into. Bank might have a broker's business, all these different things, right? So I want to figure out first and foremost, if there is systemic risk that took out First Republic, I want to see what other banks look just like First Republic Bank, right? Very, very simple. People don't think like that though. They look at the price and look at the stock prices and things like that. Stock price is kind of irrelevant here, right? Just completely ignore the price. Obviously, we want to get in at a good price when we do decide to trade it, but the current price of a stock doesn't really dictate whether or not it is a value buy or sell, or that the holding company, the institution is actually under any stress at all, right? Completely irrelevant. And I hope my lens isn't fogging up here. Other thing that I'm trying to identify, and I'm actually thinking this through right now, is there greater systemic risk? So if there is greater systemic risk for all banking, right? We know that JPM, for example, massive bank, has been putting up all this cash to buy these failed banks and take on their deposits. And we can talk about that in a second, what it actually means to buy out a bank and why they would do that. But you do that, right? You're spending cash, and we know how important cash is to banks. Now, JPM is a $1 trillion company, truly, like look at their revenue, trillions of dollars. They have a lot of cash inflows. Their business is highly diversified, much more so than a regional bank would be. But they are under stress. This is a new stress they haven't been under before, and that's key. It doesn't mean they're gonna fail, but that is key. There's a limit to the amount of banks that they can just simply buy, right? It means, let's do hypotheticals. Let's say 3 banks fail next week. JPM can't necessarily absorb all of that collateral, especially if it's a leveraged buyout, right? They're borrowing money, that debt has to be collateralized. They're probably going to get, special notes from the US government, but still, that's a lot of effort that they have to take on. They have to manage all those assets, the book of business, things like that. There is a stress there that is exacerbated by every new bank that fails, right? So say that again. Every new bank that fails creates an increased amount of systemic risk to all other banks, right? Because people trust the banks less. As people trust the banks less, more bank runs happen. That's why the government is so afraid of this. And that's why they're putting so much effort into trying to convince people that everything's okay. Because even though it's just one bank that failed, so much of our society, especially and even the markets, depends on people thinking that things are okay. We see this intraday when sentiment hysteria takes off, people buy. So even if the price is up, everyone thinks it's going to go even higher, it'll keep going higher. People start selling, people think the price is going to go lower, even though if it's already sold off a ton, it'll go even lower, right? Everything works out like that, right? Banking, financial institutions, all of that, right? If you've ever been in a crisis of any kind in life, you understand how quickly people will en masse all start doing one thing or the other, and that can completely break down, our typical social limits, right? As well as financial limits. So this is really, really key here. Now, I don't want the economy to crash. I think there are second and third order consequences that would happen from a big financial collapse. Don't want to deal with that. When I graduated college, right around 2013, and the market was not good then. I don't want that for anybody. But I'm older now, and I'm always looking for opportunity. So if there is a crash, there are more banks failing. One of the things that you can do, one of the things that I'll be doing right now, is just looking at those mid-sized banks and buying puts probably 1 to 2 months out, right? Get a good swing. These stocks come down fast. So you'll go, say you get in some puts that are $1, you get a $30 change in underlying price, right? Your premiums are going to go through the roof. IV is going to jump up, which is going to help those immensely, right? Actually, most of your money is going to be made off IV, honestly, right? Because let's say you have $2 puts and the price goes to 10, your puts still aren't in the money, but the IV is going to be out the roof, as well as the demand for those contracts is also going to be astronomical as people are trying to get in the last minute, right? So there'll be a lot of things in your favor, even with these far dated puts. The reason you have to go pretty far out though is if you try to buy like 0s, 1s, 7s, dated contracts, things like that, you'll miss. You'll constantly miss. It'll be burning premium. Now, if you have a ton of money, you can do that. That's a strategy that works for you. If you don't have a ton of money, you literally can't do that strategy. So don't waste your time trying to do it. Instead, do something that's safer. It works better for the type of risk that you can actually take on, and go farther out into the expiration. That's what I would do. The other thought that I said earlier, right? So why do banks buy banks? But why is it important for these apostles to get paid? We saw with Silicon Valley Bank, bank, the U.S. government, secured all these deposits, even above and beyond the FDIC insurance of $250,000. That to me was a really key point of data in how big the problem is and how much the government does not want this read, right? They basically said, we are going to secure deposits beyond what should even be secured, right? They want people to be made whole. They want people telling people that they were made whole. They want everyone to feel like the U.S. government has got their back, despite all the macroeconomic nonsense that's going on with inflation and things like that. Key, guys, it's so key, right? A lot of people are like, oh, that's nice. But in my mind, I'm going, they really need to stop this problem because they understand how fragile so many other banks are. And they know, guys, like they definitely know their economy is, well, it's really always kind of just balancing on a hairpin, but even more so now when we're under big economic stress. There's a lot of factors are only worsening inflation. I don't think inflation is coming off anytime soon. People keep asking if they're going to stop the rate hike. Jay Powell always says no. These meetings are actually hilarious. It's every meeting he says the same thing. People ask the same questions different ways. Like, well, now that this has happened, are you going to stop? Now that this happened, it's like, no, guys, that would exacerbate the problem. He's trying to solve inflation, which can only be done by, as far as the things that they can do, increasing interest rate. And that's just a matter of fact. It doesn't mean I like it, but I do agree with the strategy. Like that's what they have to do. We cannot go back to a low rate environment while prices are high. I mean, look at real estate, look at things like that. People are absolutely out of their freaking minds thinking that in a world where things cost more, real estate is still way overpriced due to, the advent of Airbnb investors and things like that. All these other reasons that they're going to go back to a low rate environment. You know what's going to happen to housing now that it hasn't adjusted properly yet, and then we lower rates? Prices are going to go through the roof. We're going to lock even more people out. We'll be essentially taking one step forward, 3 steps back type of situation, right? I think the housing market needs a big adjustment still, so that we can, soften the stress on essentially the middle class, which is who feels inflation the most, right? I don't really feel inflation, guys. It doesn't matter to me. I'm in a commission-based job, I day trade, things like that. Money isn't real to me anymore. But for people who money is real, half the budget and things like that, a $100 change matters. And I remember what that's like exactly, right? So the idea that you can just raise prices $7 here, $8 here, $9 here, and it not affect people is insane. Especially with housing being one of the biggest fixed costs, or really it is the biggest fixed cost of everybody's life. Reducing housing across the board by $200 a month for every American would be huge. It would be absolutely an insane amount of money into the pockets of families and people who have to buy groceries, gas. $200 a month is an insane amount of money. You could do so much for so many people, right? And you pick your number. I just picked 200. It could be $100, it could be $300, $400, whatever it is, right? So we need to solve that problem. Until that problem is solved, the middle class is always going to feel, especially lower middle class, is always going to feel this weight on their back that's insurmountable, which means there's going to be reduced consumer spending and things like that. But that is it for this video. Please do join the Discord, subscribe. Check out my other videos. See you later.